Hey Jake, how are you?
Good, Professor. How are you? How was Disneyland?
Good. Rained all
What's your,
day.
do you have a, oh,
It it was
that's
raining,
unlucky.
but the
Yeah,
crowds were bad.
I was in LA over the weekend. It was raining all the time I was there.
Another storm coming through. What do they call it? Some kind of atmospheric something something. So
Yeah.
yeah.
But do you have a favorite ride I know your grandkid you said was
I've
very
gone a
young, but
hundred times. So basically, I used to like Splash Mountain used to be my favorite ride, but now it's closed. So
yeah. Well, I didn't know they closed it, but oh, they're remodeling it, right? If I
yeah,
remember
it's
correctly.
can't be called because remember it had the racist components to it, so that redo it's called Tiana something. So it's under construction.
That's great. I thought I was gonna have I had a background ready for today, but I didn't, I guess I didn't enable it. It's okay.
That's okay. The background looks fine. There's a switch in the background. It looks, yeah.
Just my let's see if I can get it. Oh, there it is. There we go.
There we go.
We're there in
Arriba.
spirit, Professor.
Arriba. That's a good
My
background. Folks, as you join in, if you can just turn your cameras on, it makes my life a little easier because I can see faces instead of gray boxes. So if you can, turn your camera on. Before I start, so that I don't forget, um, your quiz is a week from today, the first 30 minutes of class. Let me be very specific again. It's the first 30 minutes of class, and there will be class after the quiz. So I will send you logistical details for the quiz, including the review session. I've already sent you the links to, but I will send it again in case you're not reading my emails, which is entirely possible. I'll also send you the links to all past quizzes. But here's how I'd suggest you prepare for it. Don't spend the entire next week just going through slides and going through them inside out. You have to get your hands dirty. You have to work through past prompts. And the best way to work through them is to work through the past quizzes. If you look at the quizzes, it can be a little overwhelming. I think I have 40 years of quizzes there. My advice is instead of starting with the first year and working forward, I think the very first quiz might be from 1996. Don't start with that. Start with 2023 and work backwards for two reasons. One is the material has shifted somewhat across the quizzes. So some of the earlier quizzes contain material that we're not going to cover on this one. So start 2023, 2022, 2021, 2020, and give yourself at least a couple of quizzes where you can actually test yourself out. In other words, you feel ready, give yourself 30 minutes. Time is important because without a time constraint, of course, you can solve any problem with open book, open notes. Give yourself 30 minutes, see how well you do on at least one or two of the holdout quizzes, okay? So prepare for the quizzes by working through past problems. And first 30 minutes of class, a week from today, will be your first quiz. Okay? And if you're not going to be able to make it, let me know before the quiz. Even if it's 5 minutes before the quiz, you say, look, I'm not going to be able to take the quiz. Make up at least some reason where we have both face-saving reasons for letting you miss it. So don't tell me you're not quite prepared, even if that's the case. Come up with something which is plausibly deniable. I feel sick. Now, can you reject that post-COVID? I feel COVID-y, if that's the right word. No, I will let you go. It's not, this is, I'm not going to force you to take the quiz, but remember, if you take all three quizzes, you get to drop the worst one. And that's a bonus you're looking at if you go through. Any questions before we start? Okay.
Yeah, sorry if you've said this before, but where are those quizzes located, the past ones?
You can to go back and read your email from yesterday. Maybe I sent the link again. So go back and read my email from yesterday, but at least I've sent them at least two times. So you should be able to see the links, and you click on the links. If the links don't work, just try a different browser. It's just a browser problem. It's not that the files don't exist. Jake, you had a question? You had your point?
I guess I can do a short announcement on behalf of me and Deep. We hold a review session every Thursday, guys, and we get questions about this. We're doing the quiz. We'll go over tomorrow quiz questions, practice quiz questions, and we're going to look to have it be one before the quiz next week. And Deep puts a lot of time into preparing those questions and curating them, so you guys should stop by.
Take advantage of Deep and Jake. They know this class inside out. As I said, they sat in the first row. They've taken the punishment, and they know exactly what's coming. So if you can, there's plenty of time, there's plenty of resources. So no matter how unprepared you feel right now, you have time to get prepared. Okay. So let's start this class with a couple of, the start of the class test, as we usually do. And this time, again, it's going to be focused on cash flows. So one of the things we're going to talk about today is money-losing companies. Now, some of you are valuing money-losing companies. I won't ask how many of you, because quite a few, at least 1 in 5 or 1 in 6 people should be valuing a money-losing company. How do I know that? Because in every group, there's got to be at least one money-losing company. So if you're the person who's got the money-losing company, here's what I want you to think about. But even if you're not, think about this. You have a money-losing company. One of the ways people try to fix this is by normalizing earnings. What does it mean? Taking the average earnings over the last 5 years. There are some money-losing companies, but that's going to fix the problem. My question is, which of the following companies would, taking an average of the last 5 years of earnings, allow you to get around the problem of money losing? The problem with money losing is you got a negative number up front. Which of these 5 companies will, replacing with an average earnings over the last 5 years, fix that problem? The first is a company where the loss was unusual and the company has historically made money. The second is a company that problems that caused the loss were, so as I read through each condition, do you think the first one is a requirement, that this is a company that lost money only last year, but used to make normal money? If I'm averaging, that probably is a required condition, right? If you have a company that's never made money, averaging over the last 5 years is not going to solve your problem. It was only going to make your problem worse. So this company's had to have a history of making money, but last year, something bad happened. Second, the problems that caused the loss were temporary and have largely been resolved. Implicitly, are you assuming that when you normalize earnings? Yeah, that problem's now gone. The third is the business has not changed in fundamental ways. What does that mean? A disruptor hasn't come in and shifted the economics of the business. That too is a requirement, right? And fourth, when you take average earnings across time, remember your company could have gotten much bigger or much smaller over those 5 years. Averaging earnings is going to be a strange number if your company's increased like 5-fold over the last 5 years. I kind of answered this for you, but in a sense, every one of those is required if you're going to take an average earnings over the last 5 years. That's some bad news for you. For most of you valuing money-losing companies, averaging the earnings over the last 5 years is not going to get you out of the problem, because very few companies meet all of these criteria. This is the easy way out, and for many of you, that easy way out is not going to work. Second, and this might be jumping way ahead. Remember we talked about valuing equity by discounting free cash flows to equity or the life of the company discounted back at the cost of equity. Let's say you're valuing a company today and you're doing free cash flow to equity and you're projecting out free cash flow to equity and you're projecting out the free cash flow to equity to be negative every year for the next 5 years. Let me pause right there. Now that we know the mechanics of free cash flows to equity, what are the conditions that might cause your company to have negative free cash flows to equity to be negative for the next 5 years? Andrew, you're smiling, so tell me. What are some of the conditions that might cause your company to have negative free cash flows to equity for the next 5 years, not just next year? You can't hear me, or I can't hear you because you're muted.
The audio quality here is kind of bad.
I'm sorry. Okay. Jagger, go ahead. I can't hear Andrew.
Very, very high debt payments, a lot of leverage.
Could be very high debt payments. Let's go down the list though. It could start, what's the starting point from a free cash flow?
Well, I mean, you can have very high operating expenses that
Net
are
losses. So you
net
start
loss.
with net losses, you're already in the hole.
Yeah.
You could have high
CapEx.
reinvestment, CapEx, working capital because you're growing, or you can have high debt payments. The reason high debt payments are probably the most dangerous of those 3 scenarios is there's no light at the end of the tunnel, right? You can't expect to grow out of this problem. You got to make the debt payments. But it can be any of those things. It can be money losing. It can be reinvesting a lot. It can be heavy debt payments. But whatever the reason, let's say free cash flows to equity are negative for the next 5 years. And then they turn positive. What are we asked to do? Discount the cash flows back to today using the cost of equity, right? But implicitly, is there an assumption we're making when we discount those negative free cash flows the next 5 years and then the positive cash flows after that? Jagger, I'm going to stay with you because even though your hand is probably up from before, maybe you can help me out here. What am I implicitly assuming?
You're assuming that the cost of equity like hasn't changed, even though.
So let's say I do make that change. So even the cost, so let's say the cost of equity. What else am I assuming? The cash flows become positive in years 6, 7, 8, 9, and 10, right? To get to those cash flows, though, what does this company have to do?
I mean, it has to, either reduce CapEx or like grow
It has to survive 5 years, right?
Yeah.
What happens to most companies with big negative cash flows, which are expected to be negative? They go out of business. There's a lot of failure with young startups. 2/3 of young startups don't make it to year 2. I want to talk a little bit about this failure issue because I think we're casual about it. When we do evaluation, we act like it's not a problem. We act like we always bounce back from negative years, but that's not always the case. For the moment, just file that away. It's something to think about, that failure rate, because with young companies, those of you valuing companies that are money-losing companies, where there's no clear light at the end of the tunnel right away, this has to be something you think about. What is the chance my company will not make it? So let's go back to the notes and I think we were on page 131. Up to share and reshare again because it might require. Everybody can see my slide? We're talking about R&D. So I'm going to go back to that page because there are a couple of quiz. Some of you have gotten ahead of me. There you're doing your quiz 1 and you get to question 3 or 4, which is about cash flows. And quite a few of the old quizzes, we have this issue of capitalizing an expense that was treated as an operating expense. So I want to go through the mechanics again of R&D because I did this at the very end of the last class and you might have fallen asleep or you were too exhausted or you were just checked out. Now, I want to go through it and I want to make sure if you have mechanical issues, you can bring them up here. First, Julia, remind me again why we capitalize R&D expenses. You don't want to try, you can pass if you want. I'll come back to you, Jagger. Kareem, tell me why do we capitalize operating expenses? Julia, I'll come back to you if you want to help me out in the mechanics. Kareem, why do we capitalize R&D expenses?
Because R&D, we're expecting high growth from that, so it's more so of an asset rather than an actual expense.
What was the first part of what you said? I couldn't quite hear you because.
Oh yeah, we invest into R&D because we're expecting high growth from that, like we would if we bought any regular
and
assets.
When do we expect the high growth? We expect the high growth right away, then I can count R&D as an operating expense, right?
We expect the high growth later on, so we should treat it as an asset rather than
That's the key, is we expect the benefits to be spread out over time. So it seems unfair to take the entire R&D expense and put it over in this year. So we capitalize R&D because the benefits are over many years. Julie, so now we've decided we want to capitalize R&D. In the case of, in this case with SAP, which is a software company, let's say it takes 5 years for R&D to pay off. Hang in there, because if it takes 5 years for R&D to pay off, and if you think logically, then if I have an R&D expense, what should I do? I should spread it out over 5 years. Sounds fair, right? If I have to wait 5 years to get it, why should I charge it in this year? I should take 1/5 each year. So here's how I've capitalized R&D. Because I have a 5-year life, I went back 5 years in time. 5 years ago, the R&D expense was $745 million. I'm writing off 1/5. I write off 1/5 each year. I'm writing off the last 1/5 this year. R&D from 4 years ago, $969 million. I'm writing off 1/5 each year. There's the 1/5 I'm writing off this year. There's 1/5 left over. R&D from 3 years ago, $898 million. I'm writing off 1/5. There's 2/5 left over. So I'm keeping track of two numbers. How much I'm writing off this year, which is always 1/5, and how much I haven't written off yet. The sum of that last column is basically my amortization this year. How much of the R&D I'd be showing as an expense this year. The second to last column, $2.914 billion, becomes an asset that I show on my balance sheet. This is the capital I've invested in R&D from previous years that I hope to benefit from in the future, but I have no way of knowing. And finally, because I'm replacing an operating with a capital expense, I restate my operating income. I add back this year's R&D expense, saying I should never have subtracted it out, and subtract out the amortization of 903 million, which is what I'd have had as amortization of R&D this year. So mechanically, all I'm doing is spreading my R&D expense over time to treat it like any other capital investment. We pause right there, and if you have any questions about the mechanic, because these are exactly the mechanics I do every single quiz question involving this. Jacques?
Yeah, so I was just wondering, it looks like from what you were explaining, you take 1/5 of the R&D expense from 5 years ago
Jacques, let me pause there. Why am I taking 1/5?
because you're assuming the R&D can be capitalized over 5 years.
Exactly. So if it had been 10 years, I'd be taking 1/10. If it was 3 years, I'd be taking 1/3. Okay, keep going.
Yeah, so what do you do from years -4 on? And then also
I
like,
do the 1/5 is all. This is always 1/5, right? So if you take the last column, it's always 1/5 of the second column.
mhm. And then
1/5. So this is always the amortization is always 1/5.
right. Okay, fine, because -4 is going to be still a fifth, like 1 year
Always a
out.
fifth, right? It's always a fifth. So that never changes. What will change is what's left, right? The R&D from 5 years ago, when I write off that last 1/5, there's nothing left over. The R&D from 4 years ago, there's still 1/5 left over. So this number is just whatever's left over that I haven't amortized and will be amortizing in future years.
Okay, so then when you do next year's, you get rid of year -5 1/5, and then you
Yeah.
just
I have
okay,
4/5
and
left
you just
over,
move it
right?
forward. Okay, got it, got
So
it.
basically, that's all I'm doing. Okay. Jagger?
Okay, so if I'm understanding the equation correctly, so for the increased operating income, so you just take the R&D expense of the current year and you subtract all the like the write-offs from that we just did.
You're replacing because right now, what are you doing? You're expensing the entire 1,020, right?
Yeah.
I'm saying you shouldn't do that. So we're adding that back. But if you add that back, you're replacing it with the amortization, which you'd have had if you'd been capitalizing it.
Okay, okay.
Right?
So it's just
Yeah, so that's all you're doing is replacing what used to be your expense, which is the R&D expense, with the amortization of past R&D.
and so we have to assume that all the past R&D has like the same kind of life.
Yeah, I mean, if you wanted to, you could have different lives, right? But it'll just make it just adds a layer of mess to it. It doesn't make it any, I mean, the intuition, the mechanics won't change. It'll just become messier. So you have three types of R&D as a company, one with 3-year lives. So basically, it won't be each R&D will have its own life, but you might have three groups of R&D you do as a company. One where you have a fairly quick payoff, one in which you have a longer term payoff, and one in which you got to wait a really long time. There's nothing that stops you from doing this on each of the three with different lives for each of the groups.
Okay, that makes sense.
Ogden?
So in this example, are you amortizing the R&D expense of only 1 year spread out over 5?
R&D expense is always over a year, right? So each of these is an annual expense. Because it has a 5-year life, I'm just spreading it out. So I'm not sure, maybe I'm not getting your question. So
Yeah,
when you
so this current or 5 years ago, you spent 744 on R&D, is that correct?
yeah,
Over on the right, the R&D
that's not
spread
what,
out.
no, let's replace
Yeah.
R&D with, if you built a building with a 5-year life 5 years ago, tell me how the accounting would have worked. Let's say this building had a 5-year life, or equipment, let's make it equipment. 745 million in equipment 5 years ago with a 5-year life.
Yeah.
What would accounting require you to do?
It would probably turn into PPE, property, plant, and equipment, maybe, or something similar.
And right, let's stay
Depreciate.
with straight line depreciation. So what would you be writing off each year?
You would be writing off the depreciation of that initial investment. My question is,
150 each year, right?
yeah, but if you're making R&D investments every year,
Yeah.
on the right, you're only amortizing, it seems
So let's
like,
stay with the same example. Let's suppose a company bought equipment 5 years ago, equipment 4 years ago, equipment 3 years ago, equipment 2 years ago, equipment 1 year ago. What would you be writing off as depreciation on that equipment this year? You'd be writing off 1/5 of each year, right? Because in a sense, each year you're allowed to write off only 1/5. The game continues because I'm going to continue to be writing off. So I am taking 1/5 of each year's expense because it's a rolling expense. It's an expense that spills into future years as well.
that makes sense, but my question was more on the lines that if you add up the amortization on the right, 198 to 148,
Yeah. You
that
get
only adds
903
up.
million. You get 903 million. That's the sum of the amortization. So
Yeah.
that'll show up as amortization this year. Next year, when I do this, what will be different?
Okay,
Right?
okay. Now I see it. Yeah.
Yeah. So basically, it'll just be next year, the 1020, the first depreciation on it will kick in. So next year's depreciation will be, I will take out the year -5, roll it forward 1 year.
Got it.
Yeah. So that is the process of capitalizing R&D. You see, this sounds like torture. Why are you doing this? So let's talk about, just like with leases, what the consequences are going to be for a company. First, in the case of SAP, by capitalizing these R&D expenses, I'm effectively going to increase my income by 117 million. So basically, it's the difference between the 1,020 and 903 million. So my income is going to, if I stop right there, this is good news, right? Higher earnings. When I go to my balance sheet, what I had as book equity before, I'm going to increase that book equity by the uncapitalized or the unexpensed portion of my R&D. So remember the 2.914 billion, my book equity will go up. So my earnings will be higher, my book equity will be higher. When I look at CapEx for this company, before I capitalize R&D, my net CapEx for SAP was tiny, 2 million, looked like they were reinvesting nothing. But with R&D, treated as a capital asset, my net capex jumped to 119 million. So my earnings are higher, my book value of equity is higher, my net capex is higher. And here's the thing that is going to end up puzzling you the most. When I do my free cash flow to the firm, my free cash flow to the firm is 1.283 billion. With the old accounting, it's 1.283 billion when I capitalize R&D. You're saying, what a waste of time. You're ending up with the same free cash for the firm. Why did you go through this torture to end up with the same number? Simple reason. I want to get a better sense of what this company is reinvesting, how well is it reinvesting? And the way we measure reinvestment is by looking at what the company puts in. We look at return on capital by looking at what it earns on the capital invested. And if I don't capitalize R&D, I'm not going to get a clear sense of either of those numbers. I don't capitalize R&D because it gives me a better free cash flow. It'll give me exactly the same free cash for the firm. I capitalize R&D because I want to get a sense of what the company is investing and what it's earning on those investments. And if I don't capitalize R&D, I will not get a clear sense of that. If you look at the return on equity or return on invested capital with tech firms, you see these absurdly high numbers, 88%, 150%, even for average tech firms. And the reason is the accounting as we know it now is screwed up. Their biggest investment is not showing up in the books, and I'm trying to bring it back on. So this is how you capitalize R&D. So let's take a different firm. Let's suppose you're valuing Uber. Andrew, are you valuing Uber? No. Somebody's valuing Uber in this class. Who's valuing Uber? No, not willing to accept it. Sachi, I'm going to act like you're valuing Uber. Right? Uber is a company. What is their equivalent of CapEx? They don't have land, they don't have building, they don't even own the cars. So when you think about Uber growing, what is the base that allows them to grow?
Probably the investment in their software or the platform.
That might be it, right? But that's going to be still tiny. When Uber boasts about their success, guess what they point to? We have 115 million riders, subscribers, members. You know what the analogous expense to R&D is for Uber? You want to try, Sachi? How do you get those riders?
Is it like all of the customer acquisition or like marketing
Exactly.
costs?
Customer acquisition costs for a platform company. And those are the big companies of today, the Netflixes and Ubers. That is the equivalent of CapEx. If you're Coca-Cola, and we talked about this, a brand name company, you're building your brand name by doing advertising, not so much to get people to buy more Coca-Cola today, but because you want the brand name to get built up. Some of that advertising cost should be capitalized. The way we capitalize them will be exactly the way we do R&D. So this framework we develop for R&D can be used to capitalize customer acquisition costs. It can be used to capitalize advertising costs. For an oil company, it can be exploration costs. And for an investment bank, it can be a recruiting and training costs, right? Because that's how you. So what I'd like you to think about is for your company, what is its biggest asset? And for many of your companies, it's no longer physical land or equipment. It's something else, a platform, a brand name, and what you're spending to build that up becomes the equivalent of CapEx. Sebastian?
Yeah, so for the platform company, would the life of that asset of the customer
Actually, the life
acquisition
of a
cost?
customer is what's going to drive it, right?
Yeah,
Because
so that
platform
was
company,
my
the question
question.
I'm going to ask you is how long does a customer stay on? You know, for
So you divide
Netflix,
by
what the answer
LTV
is?
or by average customer life.
Exactly. So and that's exactly what I wanted to start thinking about. Think about what makes your company valuable, then say, how do I build that up? What do I spend in to get that? And that becomes your equivalent of CapEx. So again, at the risk of repetition, let me be very clear about what accounting as we know it is doing right now. It is understating the earnings of technology, of growing technology and pharmaceutical companies. Do you see why? By expensing R&D instead of capitalizing it, they're making earnings too low. And that's often their defense. We're just being conservative. We're accountants. But in the process, they're also not showing the biggest assets of these companies on the book. So it's understating book equity, invested capital. So you understate earnings, you understate invested capital even more, you're going to misstate your return on equity and return on invested capital. Every number is being screwed up because you're not being consistent as accountants. So what we're doing when we capitalize R&D is we're cleaning up the income statement, we're cleaning up the balance sheet, and we're getting a clearer sense of, is this a great company? Is this a good company? Is this an average company? I mean, I think for too long, we've given these platform companies free ride based on the number of users and subscribers. Oh, you increase the number of subscribers 10 million, that's amazing. Notice that nobody seems to stop and ask the question, how much is it costing you to add those extra 10 million subscribers? Because it might turn out that what they're investing to get these subscribers is worth less than what they're getting from having their subscribers on the platform. So that's the CapEx part. So think about leases, think about R&D. Leases, accountants have come to their senses at least partially. R&D, I don't think it's going to happen in my lifetime. I think it's going to take them a lot longer because this is going to require almost going back to zero-based accounting because it changes accounting as we think about it. It's Sebastian.
Isn't it kind of like a different sort of concept though? Because when you're capitalizing like a lease, for example, or property, that's something that you're able to actually sell later on to someone else. But if it's something like R&D and say you don't have a patent from it, or something like a customer
But why are
acquisition
you
cost.
assuming you don't have I mean, you're starting R&D. So I could say the same thing about leases. If you're leasing and a property hasn't been quite developed, you might not. So we can talk about when this is sellable, right?
Mhm.
But let's face it, patents are sellable. Platform users, I've seen platforms sold for the number of users you have. So liquidity is what you're talking about. I could argue that any of these assets are sellable. Some you will never sell. Coca-Cola will never sell its brand name because 80% of its value comes from brand name. So if you sold the brand name, what are you left with? A generic soda that tastes crappy, right? And what do you want with that? So I think that it's not so much a sellable argument, but is it valuable? And without the riders, what's Uber worth? Nothing. Without the brand name, what's Coca-Cola worth? Nothing. You could actually argue that brand name, that Coca-Cola's brand name and Uber's riders add more to its value than a factory gives to the company owning the factory. So I think it's a question of value that we should be asking about, and we're trying to bring them on. Rachel?
Hi, Professor. I just have a question about from the last slide. Could you explain what the ignored tax benefits are? Is that just the difference in
That's
tax
a good question.
between?
I skipped over that. Right now, what are you allowed to do as a company? So let's take SAP. You're allowed to deduct the entire 1.02 billion as an expense, right? Think of what that does. It lowers your taxable income by 1.02 billion. You pay taxes on that taxable income. I now decide to capitalize it. Remember, the IRS allows them to still expense it. But I now say, look, from a valuation perspective, it makes sense for me to capitalize it. So I replace your 1.02 billion by the 903 million for my purposes. You're still deducting 1.02 billion for tax purposes. So in other words, I'm missing the tax benefit on that 117 million in expenses by replacing what you're actually deducting for taxes by what I'm hypothetically coming up with a number. So that lost tax benefit is basically from that difference between the R&D expense and amortization, because right now you're allowed to claim. If at some point in time the IRS also decided that R&D is a capital expense, then this too shall disappear. In fact, one of the issues that Congress had a few weeks ago when they renewed the R&D was the 2017 tax law actually required that R&D be capitalized for many tech companies. And this was scaring them crazy because of the tax reasons. So they managed to get a clause put in that allows them to keep expensing R&D. So that's going to continue as long as the tax law allows it. But from a valuation perspective, we're asking a different question. We're not doing this to change your taxes. We're doing this to get a better sense of how much you're worth as a company. To answer your question, Rachel?
Yeah, thank you.
So now let's talk about, I don't know how many of you have had a chance to download the financial statements for your company. So let's say wait, go ahead.
Hi, Professor. I still have a follow-up question for the last one.
Yeah.
So, if like for example, the expense, because in the example, the expense is larger than the correct
Does the
amortization we
reverse
have.
happen?
But yeah,
Would the
what if
amortization
they
be
reverse
higher?
it? Yeah, so isn't
What
that
type?
not
No,
a
it can be, but let's talk about what types of companies it's most likely to happen. It depends on what's happening to R&D expenses over time, right? Here, the R&D expenses are growing over time. If R&D expenses are flat over time, they're exactly the same number over time, then what's going to be true?
it's gonna be zero.
It's going to offset. And if the R&D
Yeah.
expenses are decreasing over time, then you will have your scenario where the amortization is actually greater than the expense. That's okay. So in some cases, your earnings could actually decrease when you capitalize R&D because you're a mature or declining company. And by doing what I'm doing, it's still the same end game applies. This is a better measure of earnings than the earnings the accountants told me. So don't always expect the operating income to go up when you capitalize R&D. In some cases, it might be flat. In some cases, it might actually decrease.
So it depends whether it's a tax benefit or it's
No,
like
it
a
depends on
loss,
whether
right?
it's growing R&D, flat R&D, or declining. The tax thing is going to be the tax issue, but the tax issue will get reversed when you have declining R&D. But the driver of what's is what's happening to R&D over time.
Okay, great. Thank you.
So let's say you take a look at Andrew, you have a question? You're muted.
I'm just trying to, I just wanted you to answer the next question.
This one, the one-time charges. So I'll let you answer. So you answer the question. Let's say you're valuing a firm that's reporting a loss of $500 million, but it's due to a one-time charge of $1 billion. Is that the question you wanted to answer?
I would use a profit of 500 million because
tell
that's
me
the
why.
regular.
What is it about the problem that allows you to?
because this thing won't be happening going forward. So when we project future cash flows, we should
It's a
use
one-time loss, right? Extraordinary charges. You're going to see this in your company and you're going to feel, I'm going to add it back. It's extraordinary. But you remember the old Russian saying, trust but verify? Here's why I bring that up. Is sometimes companies play games with extraordinary charges. What I mean by that is they take something that's an actual operating expense, and rather than showing it as an operating expense, they show it once every 5 years as an extraordinary charge, hoping that you will ignore it because it's extraordinary. You think that's so unethical. It might or might not be unethical, but it's reality. So let's say you look at this company and you notice it's showing a $1 billion one-time charge every 5 years. Would your answer be different?
I would not add anything back.
Maybe some of it back because once every 5 years, what does it look like?
Oh, once every 5 years. Oh, then it would be like 300 million profit.
Exactly. You got it, right? Did everybody get the 300 million? What you're doing then is you're saying, look, you guys are playing games with me. It should be a $200 million expense every year. You're acting like it's lumping up, but I'm going to do the right thing and act like you have a $200 million expense every year. And if I take 200 million off the 500 million, that gives me a $300 million profit. So the answer to two would be I'd use a $300 million profit because it's once every 5 years. You say, what a pain in the neck. You can't trust companies based on what they call something, right? I remember I was valuing Xerox when it's still a company. Now it's just a shell case. And it had extraordinary charges every year for 17 years. You have extraordinary charges every year for 17 years. This isn't extraordinary. This is an ordinary charge. You're just calling it extraordinary because you don't feel like taking the expense. So look across time for your company. That's one of the advantages of having Capital IQ is you can download your financials for your company for the last 30 years. And then if you can look, if there's an item that shows up, every 6 years, you're going to catch it. So if you have one-time charges, you can take them out, but make sure they're truly one-time. Let's move to the fourth one. And this, I would admit, this is, go ahead, Jagger.
If there's like a company does like an M&A deal like every few years, do you still count that as not a
They
one-time?
do it on a regular basis, and usually the expenses associated with M&A are restructuring charges, M&A charges. So if this is the way they grow and they have this charge showing up once every 5 years, I think you have to, right? Because you're going to count the good stuff that comes from these acquisitions through their growth rate. This is one of the bad things, and you've got to make sure it gets counted as well.
Okay.
Oh, am I getting your name right? It's not a Yager. It's
No, you're right. It's Jagger.
okay.
Jagger.
I just want to make sure that I'm not getting it wrong.
Thanks.
Now let's move on to what really, really should keep you up at night if you're valuing companies. Nothing should really keep you up at night from investing, but let's say, and that is whether you like it or not, you're trusting the accountants, right? When you look at that income statement, that earnings, and I'm not even talking about accounting rules like whether they're expensing the right thing. But if they're committing downright fraud, an outright fraud, the numbers are a concoction. Everything you do, you can be you can know everything there is no about valuation. But if your base numbers are, not just flawed, but just crooked numbers, your valuation is screwed. How do you know your company's numbers are not being cooked? You could ask the company, are you cooking your numbers? What do you think you're going to get as an answer? Of course not. You can ask the regulatory authorities, but if they thought the numbers were being cooked, they'd have shut it down already. So the bottom line is there's no place in an income statement where they're going to tell you, guess what, guys, we're cooking the books here. We just wanted to let you know. So there's this whole branch of accounting called forensic accounting. I think accounting is a horrendously boring, profession, but forensic accounting might be the one area of accounting which is not incredibly boring. You know what forensic accountants do? They go through traditional accounting statements looking for clues that tell them that somebody's playing games on them. I won't go through a whole list, but I'll give you one clue. You know how you look at an income statement, you get the earnings for a company, right? No, so the accounting. If you go to the statement of cash flows, The very first section of a statement of cash flows is called the operating cash flow section. And what do? You start with net income, and then you start to adjust for you add back the non-cash charges, and then you subtract out change in working capital. And at the end of the operating cash flow section, there is an end number that you get that you can think of as cash. It's basically a cash earnings for your company. So in your income statement, you got your accrual earnings. In your statement of cash flows, you're going to get a cash earnings. Will the two numbers be equal? No. Right? In a healthy company, though, you should go back and forth. One year, the accrual income will be higher. The next year, the cash income will be higher the year, because it just ebbs and flows. But if you have a company where the cash income consistently runs ahead of the operating income, or what you see in the income statement, something is not right here. They're playing some kind of game, a deferral game, where their income is low, but their income is high, but the cash income is low. In other words, they're not making much in cash flows, but they're selling stuff for credit, reporting it as revenues, showing a high income, but they're not making cash flows. If year after year, your cash income is lagging your accrual income, I'm not saying it's a guarantee that there's fraud, but you should probably check the numbers closer. If you see a company's effective tax rate swing wildly, every company's effective tax rate changes over time. But usually it'll go from 13% to 17% back to 15%. But let's say in your company, your effective tax rate goes from 43% to minus 35% to 61% to minus 86%. You know what that tells you? This company has two sets of books. It's perfectly legal in the US. One for the tax guy and one for your reporting statements. Again, no guarantee that it definitely means fraud, but something to watch out for. I won't go through a whole list, but there's books on forensic accounting. I'll send you a couple of, if you're interested in this and you want to check it out in your company, I'll send you a couple of easy to read forensic accounting books where you can get into these are the 12 things I would look at in my company to see if I should be worried about fraud. There are parts of the world where you can't take financial statements at face value because the auditing is a joke, the accounting oversight is a joke, companies can commit fraud, and it's your job. It's caveat emptor. You're buying the stock. You have to do the due diligence. So any questions on accounting fraud? If any of you are working with companies where you don't trust the managers, you don't trust the accountants, you might want to check out one of these books to see if your company, you need to do something about it. Last piece of the earnings puzzle, when we're dealing with earnings, as I said, if you have a money-losing company, then you might want to look at why your company is losing money. And you think that's obvious because their expenses exceed you're right. Mechanically, that's why you're losing money. But here are the possible reasons from easiest to deal with to most difficult. The first is what Andrew pointed out. If you have a one-time charge that's truly one-time, you just got lucky. You have a money-losing company. All you need to do is take the loss out, compute what your earnings would have been without that loss, and do your valuation based on that. About 15 years ago, I was valuing Boeing, and Boeing is a unionized company where every 5 or 10 years, a union contract comes up for renewal. And there's often a strike around that contract. Okay, that's how the union kind of flexes its muscle. And when you have a strike at Boeing, it's incredibly expensive. It's your assembly lines have to be shut down, and it costs hundreds of millions of dollars to get them running again. So the years in which Boeing used to have strikes used to be years where you got this loss. $1 billion, $1.5 billion. Not truly one time because it happens every 10 years, but that's one of those scenarios where you can say, look, that loss is unusual. I'm going to add most of it back, maybe not all of it back, and act like I made money. Your problem just went away. You don't have a money-losing company. You now have a money-making company. Second reason you can have a loss. You know that almost every oil company in the world lost money in 2020. I don't think there was a single oil company. Maybe Aramco might have made money. What was it about 2020 that made it so diabolically dangerous for oil companies? Yeah.
There was no demand because everyone was in their house.
And how does it manifest? They have no demand. So what happened to oil prices?
drop because
They
demand.
dropped. Remember that was the year where oil prices dropped to $30 a barrel with COVID. $30 a barrel. There isn't a single oil company in the world that can produce oil at less than $30 a barrel. The cost of getting the oil out of the ground is great. They've all reported losses. But if you're valuing an oil company in 2020, you might still have been okay. And here's why. Oil through its life as a commodity has moved through cycles. You know what I mean by that? There are great years, there are average years, there are bad years. So one way in which we value commodity companies, not just oil, is we look at that cycle and we say, we're at $30. This can't stay at $30. It's going to go back to a normal oil price. So you can look across a cycle to come up with what that normalized price is, and you can value companies using that normalized price. So if you have a commodity company that's losing money, and it's losing money because the commodity price has collapsed, not because the company is bad, then you can replace the current earnings with what you'd have made at a normal oil price. Now let's come to the two more difficult scenarios. Some of you are valuing young companies, Palantir, it could be Uber, it could be Airbnb. Especially the last decade, a lot of companies went public before they were quite ready in terms of business model. With these companies, you have losses, but the losses are not uncommon. It's exactly what you'd expect for a young company early in the life cycle. In other words, you have a life cycle problem. It's not a bad company problem. It's where you are in the life cycle that's causing you to lose money. You see why this matters, right? You can't normalize earnings next year and make them positive because that's not the way the world works. You got to take your time, bring your company through the life cycle, even if you think it's a great company, which means even in your upbeat scenarios, you're actually going to lose money for the next 3, 4, 5 years before you turn the corner. Or you can have a company, and this is a more negative scenario, where there are structural problems. Like what? You used to make great products, but you don't anymore. Your factories are inefficient, cost you 30% more to produce a car than your competitors. You're losing money. This isn't going to go away next year. You can't replace your factories next year. You can't make your cars more desirable next year. If you're valuing GM and they're losing money, I don't know whether they are, but let's say they're losing money. Do you think GM's problems are going to be fixed in 2025? I don't think so. It might, even if you're an optimist on GM, you might say, look, over the next 5 years, maybe they can come up with an electric car not called the Volt that people will buy that they think is attractive. Maybe they will get their factories delivering higher efficiency. But with both the young company and the structural problem, you have to kind of map out a pathway back to profits that might take 5, 6, or even 8 years to do. So we're going to talk about how to do that in terms of growth and setting margins, but this is not going to happen overnight. Jagger?
What about a structural industry problem? Like how would you?
Infrastructure, right? You're building toll roads.
Yeah, well, I was referring more like if like the industry, it's like a specific industry is like really suffering right now. I guess the infrastructure, but I was talking more like media and entertainment.
Okay, that's a good question. So what do you have to do? If you're valuing these companies, first you got to take a point of view on, is this temporary or is this permanent? What do you think about entertainment? Is this something they're going to bounce back from next year? Does it look like Paramount and Warner and Disney have a pathway to,
Like ever cost, yeah, but not next year.
yeah. So in a sense, you'd have to do the same thing, but now you're doing this for the entire industry, but you're also mapping out your company's story in the industry. So let's say you believe that entertainment is going to find its way back, because right now it's broken. But you think some companies are better positioned than others. I'll give you my views. I'm not trying to impose mine on yours. I think that when I look at the entertainment business, there isn't a single healthy entertainment company. Netflix is growing fast, but it's not healthy. Its content cost is too high. I think that entertainment will survive as a business. You know why? Because we consume immense amounts of it. The business is not going away. But I do think 10 years out, there are going to be 3 or 4 winners in this business. I'll give you my choices and you can make yours. I think Netflix is going to find a way to some more sane model where they don't have as much crap they make as content. I do think Disney is going to make its way back because it is the content king in this business. Nobody produces as much quality content as Disney. And then after that, it becomes a struggle, right? Is it going to be Warner that wins out, Paramount? Because they can't all survive. I would wager that half of the existing entertainment business is going to be gone. So if you're valuing an entertainment company, you got to take a point of view about both the business and the company you're valuing and map out what you think will happen to your company.
Okay, got it. But so don't use like the industry average market.
Yeah, because I think the industry average is kind of because this industry is going to converge on a different mean going forward. I don't know what the margins will look like. Maybe we'll all be streaming 10 years from now. And remember, the historical movie business, what was it dependent on? Movie theaters, right? Have you taken a look at any of the movie theater companies?
Yeah.
What do they look like?
Well, I mean, AMC is Cinemark's actually doing like fine relatively, but AMC is very close to bankruptcy.
And it's the biggest chain in the US, right? So in a sense,
Cineworld went bankrupt.
So I think in a sense, the business itself is kind of shifting and changing. That's the bad news. The good news is the demand in terms of money being spent on entertainment is there, but it's going somewhere else. It's going to streaming platforms. It's going on, whatever. So I think that's going to be the big challenge in valuing any entertainment company, is thinking about what the business will look like and where your company will fit in that business.
Okay, got it. Thank you.
Let's complete the cash flow picture, right? To get to free cash flow to the firm, I started with operating income and multiplied by 1 minus the tax rate. Remember, that's way back 2 sessions ago when I introduced free cash flow to the firm. Now, question I'm going to ask is about that tax rate. Now, this is a question we asked about cost of debt as well. Christina, do you remember what tax rate we said we should use in the cost of debt?
I think you said it should be the marginal tax rate.
Don't put it back on me. So I'm going to put it back on you. I said it, but why should we use the marginal tax rate?
I think it's because I'm struggling to remember a little bit, but I think it's because it's like when you have like an additional like debt payments or something, like
you
it
got
goes.
it, right? Interest
Okay.
saves you taxes on the last dollars of income because you're subtracting from the top. That's why you use the marginal tax rate. This is a different question. This is about the tax rate I'm going to apply to all of my operating income. So here are the choices. I can use the effective tax rate, which I could not with cost of debt, but it's an average tax rate. I can use a tax rate that I compute myself by using taxes paid divided by EBIT. So it's kind of take the taxes from the income, from the cash flow statement. I could use the marginal tax rate of the country in which the company operates. I could use a weighted average marginal tax rate of all the countries. If you're in 50 countries, a weighted average. Maybe the answer is none of the above. Well, this would be nice if it were true. I can use any tax rate I want as long as I stay consistent. You know why that would be nice if it were true? What's the easiest tax rate to work with in valuation?
0.
0. So if it were true, I just ignore taxes, right? You said just be consistent. So it can't be true. The question is really effective versus marginal tax rate. Now, why don't I follow the same rule that I did when I did cost of debt and just use the marginal tax rate? What would I do if I value companies using just the marginal tax rate?
You would overestimate the tax.
You'd overestimate the tax and undervalue the company, right? In fact, let's step back. Why? In the average effective tax rate for global companies last year was about 17%. The average marginal tax rate was closer to 25%. So this is kind of a step back kind of question. Why do companies pay lower effective tax rates than what the tax code requires them to? What are the reasons why effective tax rates are lower than the marginal tax rate? Wrong? You want to try?
Yeah. Maybe because they have like loss in the past.
Maybe they have
and
clever
then
tax accountants, right? Remember, every company has all these tax accountants. What's the job of the tax accountant and the transfer pricing people is to figure out a way to pay less in taxes legally. So I'm not talking about people who break the law, is to pay less in taxes than the tax code allows. We call this tax deferral, right? We defer taxes. It's not that you don't pay taxes, it's you're pushing your taxes into future years. So one is tax deferral. Somebody else had a hand up. Why else might the effective tax rate be lower? Jaga?
Well, I don't know if this is actually a difference between effective tax rate and marginal, but is it because of like non-cash expenses or
That's part of the tax referral. So what companies often do is if it's a non-cash expense, your taxable income should be lower. So effective tax rate and the marginal tax rate shouldn't diverge too much on that. But if you can find a way to use non-cash items to defer taxes to future years, that too can cause your effective tax rate to be lower than the marginal tax rate. Sachi?
I was also thinking like companies that take advantage of tax credits.
Which is fine, right? Because especially if you invest in green energy, the government might give you tax credits. The tax credits can lower your taxes. Put simply, there are lots of ways companies can play the tax game without breaking the law. It's almost a given. If I use the marginal tax rate from this day on, I'm essentially saying you will never defer taxes again, which I think is a little extreme, right? Companies still have tax laws. If I use the effective tax rate from this time on forever, what's the assumption I'm making there then? Sebastian, you want to try? If I assume a 16% effective tax rate, which is what Apple was paying last year as the tax rate in perpetuity, what am I effectively assuming Apple's going to be able to do forever?
Keep the exact same level of earnings
Or
forever.
defer income forever.
Mm.
Which is not just dangerous, probably illegal. There's probably a padded cell in a federal penitentiary waiting for me if I think I can defer taxes forever. So you think, so I can't use the effective tax rate forever. I can't use the marginal tax rate. Is there a way I can split the difference, have my cake and eat it too? Julia, what do you think? Is there a way I can use both the effective tax rate and the marginal tax rate in evaluation so I'm not getting into either problem?
Probably, but I'm not really sure how you would do that.
Can I open the door for you? Do I have to use the same tax rate every year? Once I pick a tax rate, am I stuck with it forever?
No.
Can I
So
start
you could, I guess,
16% in
like,
year one, 16% in year two, 16% in year three? And over time, what can I do? I can move the tax rate up to 25%, at least my terminal value calculation. If you look at the spreadsheet that I've sent you, that's exactly what I do. I ask you for the effective tax rate. I ask you for the marginal tax rate. I know you're going to defer taxes, but I cut you off at the pass and say, hey, when you get to terminal value, I'm not going to let you defer taxes forever. I'm going to move your tax rate to the 25%. I think in too many valuation discussions, we make it about which tax rate should I use when the answer is, why not both? Because I think the right thing to do here is to use both, is to bring in both. So any questions about effective versus marginal tax rate? So when you look at the right tax rate to use, start with the effective tax rate because you're being realistic. My company will continue to defer taxes, but over time, move your tax rate towards your marginal tax rate because no company can defer taxes forever. I know you've heard all this talk about, tech companies in the US having an Irish sub. I don't even, there's a special name for it specifically to save taxes. And it's true, tech companies in the US have used their Irish dummy corporations to lower their effective tax rate. But it doesn't permanently lower your tax rate. It's just a way of deferring taxes until it eventually catches up with you. Sebastian?
But won't your average tax rate always be lower than your marginal tax rate?
Yeah, because if I do it for 10 years, if I do the effective tax rate for but when you get to steady state and your growth starts to approach that of the economy, the two converge. In fact, there are about 25% of US companies that have effective tax rates that exceed the marginal tax rate. Why? Because their tax deferrals have caught up with them. They can't run anymore. So their effective tax rates can be 34, 36, 38%. So some of you might be valuing companies where your effective tax rate is going to be higher than the marginal tax rate. There too, you got to, kind of bring it back to the marginal because you don't want to make them continue to pay 36% of their income in taxes in perpetuity. So about 1 in 4 companies actually has an effective tax rate that exceeds the marginal tax rate. And in fact, effective tax rates can be negative for some companies. You think, how does that happen? You can actually claim a tax savings in a year because you got so much in tax credit. So you're actually getting a tax inflow from the IRS while you're reporting a taxable income. So you end up with this negative tax rate. Again, a number that really doesn't mean much from a forward-looking basis, but I'm saying get ready for effective tax rates. It can be all over the place. Kareem?
So then for the quiz, if we have a question where it is we have to project like the future cash flows for like the next year or the next 2 years, how should we go about, like, for year one, we use the effective tax rate, then year two, we move to the marginal tax rate, or like how would we go about doing that?
If there's a problem in the quiz where I give you an effective tax rate and a marginal tax rate,
Yeah.
and I
If
ask you to
that's ever
estimate
case.
cash flows, use the effective tax rate for the growth period, but for the terminal year, which is what you use to compute your closure, use the marginal tax rate.
Okay, thank you.
Yeah. Now, just a little tangent. Some of you, when you're valuing money-losing companies, you know how taxes work when you're a money-losing company, right? You don't pay taxes usually when you lose money. But there's another factor with money-losing companies you got to keep in mind. That loss is not gone forever. You're allowed to accumulate your losses and carry it forward. It's called an NOL, or a net operating loss. And you know what you're allowed to do with that NOL? When you start to make money, you're allowed to use that NOL to cover your taxable income, so you don't have to pay taxes. So let's play a game. Let's suppose you're valuing a company, I'm sorry, with $1 billion in net operating losses. Let's suppose this company is expected to have pre-tax operating income, EBIT, of 500 million every year for the next 3 years. Somebody want to tell me what I'd be paying in taxes in each of those years and what the tax rate is going to be? Jacques, you want to try? What's my tax rate? How much will I be paying in taxes in year one?
How far can you spread out the billion in
Your
loss?
NOLs you're allowed to carry forward as long as you want now. There used to be a time limit. You can carry this forward for as long as you want. So in year one, what are you going to do?
Pay nothing.
Pay nothing. So you've used up a $500 million of your NOL. You
And
still have
then
a $500 million left. Year two,
still
nothing
pay
again.
nothing.
And year three, you have to start
You
paying
pay
taxes. So
40%.
this again means your tax rate will vary across time with a money-losing company. So with money-losing companies, this is an added layer of mess, right? You got to deal with, because this NOL has got to be tracked. You're allowed to, again, one of the reasons I call my spreadsheet the Ginzu spreadsheet, and I told you the story in my, if you watch the YouTube video of why I call it Ginzu, it's after that original infomercial with Ginzu knives, where this guy, I remember that was the very first TV show I saw when I landed in the US as a 19-year-old. This shows you the cultural shock. I land in LA, the first show I see is a half-hour commercial for Ginzu knives. So if you've never seen the commercial, it's a classic. This Japanese chef shows up with a Ginzu knife. $19.99 for the knife. And for the next 28 minutes, he keeps adding more and more knives to the mix. If you go call in the next 2 minutes, I'll throw in these 3 extra knives. And if you waited all 30 minutes, you had enough knives to be a serial killer of an entire town, like 50 knives in there. I call my spreadsheet a Ginzu spreadsheet for the same reason. I started saying, I want a valuation spreadsheet. And then I said, but what if the company is losing money? Let's build it into the spreadsheet. So what I've tried to do in my spreadsheet is allow you to enter the NOL, and I'll take care of the dirty work of carrying it forward. Not because you couldn't do it yourself, this isn't rocket science, but because it's a pain in the neck to track the NOL, carry it over time. So take a look at what I do with that NOL in the spreadsheet, because that's exactly what I do. I carry it forward to use it to cover my taxable income in future years. Jagger?
Are there any like adjustments for the NOL? Like, does that 1 billion like go up or down?
No, it's a spec. So you don't get any inflation adjustments. So it's basically whatever the nominal losses from previous years, which means even though you get the tax savings, it's going to be in a future year. So that's why building it into your discounted cash flow valuation, you're building in both the time value of money, because you got to wait to get the tax benefits, and a very real chance you might never get the tax benefit if you never make money.
Hmm.
Let's talk about net capital expenditure. Net capital expenditure, I'll give you the standard definition is CapEx minus depreciation. Why do I net out depreciation? Because depreciation is a cash expense. It's a non-cash expense. It lowers my earnings, but the cash is still there. So I net it out just to get it, because depreciation pays for some or a big chunk of my CapEx. Now we can talk about mechanics, but before you talk about mechanics, I want you to think about two fundamental principles about that net CapEx. One is it should be much higher for a high growth firm than a low growth firm. Everybody get that intuitively? I mean, if you're growing, you need. And second, whatever assumptions you make about net CapEx in your valuation have to be linked up to your growth assumptions. I want to hold you accountable, because if you get too low a value, you know what you're going to be tempted to do. Come back and increase the growth rate. When you increase the growth rate, I'm always going to be the skunk at the party saying, that's nice, but how much will you have to reinvest to get this higher growth? Connect the two at the head. Rafi, you have a question?
Yeah, on the net operating losses thing,
Yep.
if there's a company that keeps on losing money and they think they'll never be able to make money, does that company then have value because of the tax credits? Can it like sell its stuff?
That's actually a great question. When we do the M&A part, I'll talk about people used to buy shell companies with big NOLs. You see why you did that, right? You'd get the NOL and offset your income against that NOL. So a company would have nothing of value except this tax benefit from the NOL. So in the 1980s, this used to be allowed in law. You could buy a money-losing company, take the NOLs, and set it off against the income. Here's something you can almost guarantee is going to be true. If the IRS finds itself losing tax revenue, the law will eventually change. It might take a while, but it eventually will. In this case, starting in the 1990s, going through today, the tax laws have become tighter and tighter about how you can use the NOL. So now if you bought a money-losing company with an NOL, the IRS will step in and say, no, you can't use that NOL against your business, because your business is a very different business. You're making toys, you bought this chemical company with an NOL, one has nothing to do with the other. So now you have all these needles to thread and make sure that every I is dotted and every T is crossed before an NOL becomes it. So I'd be careful about buying NOLs just for the tax benefits, because if you don't meet the tax laws, it might never work. Jacques?
In that situation, wouldn't the buyer just be paying however much the tax credits are worth? Like, what would be the advantage there?
Well, it depends on whether you can get it for less, right? You're saying if you're the only buyer in town and you have, let's say you have a huge NOL, $50 billion NOL. First, it already cuts off the number of potential buyers, right? Because you need to be making enough money to cover that NOL. Now, of course, if 10 money-making companies decide to compete, it's true the ending price might very well be the present value of the tax benefit in the NOL. But in acquisitions, what are you constantly looking for? Maybe I'll find a bargain. Maybe I'll find a bargain. You're right. Most of the time on a pure NOL, it's very difficult to find a bargain because other people will pay roughly the same amount. But I'll tell you one scenario where let's say you're a company in a high tax rate country, much higher than the rest of the world. Do you see why you're going to be going after these NOL companies in other countries, hoping to use a higher tax rate as your reason for getting a much greater benefit? Because you're hoping other companies drop out of their tax rates, but your tax rate is much higher. So I'm not saying it's going to be easy, but companies get it. So often find a way to get these tax benefits at less than what they would get from taking the NOL and multiplying by the tax rate. Now, as we talk about CapEx, though, I want to again broaden your vision beyond what accountants call as CapEx. Now, if you don't believe me, go to the statement of cash flows for your company, look at the item capital expenditures, see what accountants throw in there. Almost always it's going to be land, building, equipment, machinery. It's almost like accountants never left. Forget the 20th century, the middle of the 20th century, every company, the CapEx is land, building, equipment, machinery, factories. And what did we just say? We talked about R&D, right? It's a CapEx. Customer acquisitions, CapEx. So the first thing I want you to think about is broaden your view of CapEx to include those items as well. Second, if you're in a hurry to grow, remember traditional CapEx means taking projects and growing, but that takes so much time, so much effort. What if I could give you a shortcut to growth? What does that mean? What if you could do acquisitions? Acquisitions are just gigantic CapEx where the payoff happens quicker. In my valuations, acquisitions are treated like CapEx. So to me, there's no difference between a company that grows by taking projects and a company that does acquisitions. Either way, it's CapEx, which means I can get very different numbers for a company than what the accountants are giving me. Incidentally, to show you how much CapEx can be a factor. I took a company that became legendary in the 1990s because it grew almost entirely through acquisitions. It's a company called Cisco. It's a network equipment company that took off with the .com. It created the architecture. So when I see NVIDIA today, which is reporting earnings after close of trade today, NVIDIA provides the architecture for AI. Cisco provided the architecture for the .com boom. So it grew with the .com boom, and it grew by acquiring other companies. So the way Cisco would grow, it'd go by other small companies with technologies they could use, and almost all of their CapEx took the form of acquisitions. So I valued Cisco in 99, peak of Cisco's success, because there was a brief time in 99 where Cisco became the most valuable company in the world in terms of market cap. They spent $2.5 billion on acquisitions just in that 1 year. You're saying, what's this purchase pooling? Prior to 2001, companies in the US were allowed to classify their acquisitions either as pooling or as purchase. The difference was if you did purchase accounting, you had to show goodwill, which is what you see today. But if you did pooling, it just slipped through. You never even saw it. Today, it's all purchase accounting, all goodwill based. But the big number is the 2.5 billion. When I computed the net CapEx for Cisco in 99, I started with the accounting CapEx and depreciation, which gave me a net CapEx of 98 million, tiny. But then I added R&D, which I amortized just like I did for SAP, which added another 485 million. And then I added acquisitions, 2.5 billion. My total net CapEx for Cisco was 3.7 billion. So you know what that's going to do to my free cash flow to the firm for Cisco in 99, right? You put in a net CapEx of 3.7 billion, it makes their free cash flow negative. You're saying, that's awful. You're being so unfair. True, on the free cash flow, it's negative, but how do I potentially reward Cisco for what they've done? I give them a really high growth rate because of what I think they could do with their acquisitions. You got to decide. If you want to count the growth that comes from acquisitions as part of the growth for your company, you have no choice but to view the money spent on those acquisitions as part of CapEx. You can't have the milk without the cow. I mean, that's what people try to do. They try to count the growth from acquisitions, act like the acquisitions are not there. I have no problem with you counting the good stuff if you also count the bad stuff. So define CapEx as broadly as you can. Which brings me to so Jagger?
Don't most companies, have a line item on the cash flow statement in the cash flow from investing for acquisitions?
If they pay with cash.
So where does it show up if they pay in stock?
Footnotes. So if they pay with stock, the only way to find out is to go through the footnotes. That's what I mean. I wish all acquisitions were cash because life would be easy then. You could say it in the statement of cash flows. But if you pay with stock, it shows as a footnote because, and the footnotes can be huge, right? Because, Disney, when it bought Fox for 70 billion, paid almost 2/3, 3/4 of that with stock. Right? So then you got to dig through the footnotes to see what they spent money on. Pain in the neck. What choice do you have?
Got it.
Yeah. Which brings me to working capital. What's the accounting definition of working capital? Andrew, what did your accounting professor tell you working capital was? What's the definition?
It's the difference between current assets and current liabilities.
Which is working
Yeah.
capital, right? That's how I start accounting. That's not the definition I want you to think about in valuation. In valuation, the definition of working capital is the difference between non-cash current assets, so take cash out of the current assets, and non-debt current liabilities. Remember, current liabilities include short-term debt and short-term portion of long-term debt. Take them out. I'll give you the easy part of why. Why do I take debt out of current liabilities? Because I treat debt as debt in my cost of capital. It's a source of capital. You can't have a source of capital also be part of working capital. So because I counted debt as part of working capital, I'm not going to count it in my work. You say, why are you taking cash out? It's a little more subtle. But let's take another item of working capital that we do count, inventory. Let's say you run a store and you have a lot of inventory. Is that good news or bad news that you have a lot of inventory? Tell me the good news of having your shoe store. You have a lot of inventory. What's the good news about having a lot of inventory, Jagger?
A lot of potential sales, like you have, if there
People
is,
come in and say, I want a 9.5 size in this style, you have it, right? That's a good news. What's the bad news, Jagger?
I mean, if there's low demand, you have high cost inventory. That's just like a lot of lost money.
And why does it look? Because while it's sitting on your shelves, it's a wasting asset. That's why we worry about working capital. The question is cash a wasting asset? Many of you have companies with billions of dollars in cash. I looked at Google last week, 110 billion in cash. When you see cash and marketable securities of 110 billion, where is that money usually held for it to qualify as cash and marketable securities? Sachi, you want to try? When a company says we have 10 billion in cash,
Usually like short-term T-bills, I
why don't
think.
they just keep it as currency sitting around the company, like a room full of cash?
Because at least they can get some risk-free growth and
And not to mention the fact that somebody's going to, it'll be like Ocean's 15, somebody breaking into your headquarters to steal all your cash, right? So when you see cash, it's not held as cash, it's held as something liquid and close to riskless. Right now in the US, if you're looking at Google, what's liquid and close to riskless? What are you going to be investing in? T-bills or commercial paper? What do you think you're making right now on those? I invested my money in T-bills this morning. I got 5.06%. Google earns roughly 5.06% as well. You think, but they're big. It doesn't matter. T-bills are T-bills. You think that's terrible. That's a low rate of return. It is a low but fair rate of return. Why? Because anybody investing in something liquid and riskless would earn 5.06%. You see where I'm going? Cash is not a wasting asset. It earns a fair rate of return. And if it earns a fair rate of return, then you shouldn't be counting it as part of working capital. It's not draining your cash flows. So with that said, I'm going to close off today's discussion with 3 things about working capital you're going to run into. One is, if you're projecting working capital, just project it out as an aggregated item. Don't break it out into receivables and inventory. You're going to drive yourself crazy if you try to forecast individual items. Just do a consolidated number and make it a percentage of revenues if need be, because the number will jump around. And some of you might have negative working capital. It's okay. There are some companies that collect the money from customers first and pay for their stuff later. It'll increase your cash flows. Don't try to fight it. It is part of the business plan. And as you scale up, it's going to get more and more difficult to keep it negative. Amazon, when it started, had negative working capital. They sold the books because remember, they were an online book retailer. They got the books on credit from publishers. They sold them. They collected the cash. Took 3 months to pay their publishers. Used that to grow. It's fine when you're a small company, but as they've scaled up, much more difficult to do. So I'm going to leave you with that point. And Jake has something to say, so I'll let him finish off today's session and we'll wrap up. Go ahead, Jake.
Yes. I just got a couple messages about this, guys. So I want to clear this up. Tomorrow's review session is at 11 a.m. That's confirmed just to give you guys a little more extra time to ask us questions about the quiz. We're going to start right at 11. And we are looking to see if we can move the review session from next Thursday to Tuesday before the quiz so you can ask questions. So we'll send out an announcement confirming all that. If you have any more questions,
Jake,
email.
just make sure you don't, because I'm doing Tuesday. I forgot. I'll do a 2-hour office hours on Tuesday late in the evening from 4:30 to 6:30. So that way, if you have last minute questions, you work through the quizzes, you can come in, you can share your questions. I'll record that review session. So that way you have any remaining questions, you'll have a chance to ask, you'll have a forum to ask those questions. So between me, Jake, and Deep, we have you covered. If you want to kind of get your doubts resolved, if you don't care about them, we can't do much about it. So it's your decision to make. The resources will be there. You'll have enough practice problems. And don't lose sleep over this. It's just a quiz. Worst case scenario, it do badly. It's your freebie. Throw it out. You have 2 more quizzes to go. don't let the pressures of the world mount up on your shoulders. It's a pretty straightforward quiz. It's open book, open notes. I'm not testing you on what you've memorized. So basically, you can bring your lecture notes, you can bring your whatever, you can work through your past quizzes. Now, it's the one thing you cannot do is open your laptop, partly because it's a nightmare when 260 people open their laptops in that room and all try to work at the same time. The beeping alone would drive you crazy. So no open laptops. You can bring calculators if you still have them. If the only place your iPads you can use, but only as to either look up the notes or as a calculator. Don't use it for Excel spreadsheets because I have an iPad Pro. I know you can open up Excel spreadsheets, so no laptop equivalent tools. But you can bring calculators, you can bring iPads, you can make your phone into a calculator, whatever you want to do. But come in with whatever you're going to have as your accessory, bring it in with you. Okay, so I will see you on Monday in class. So we'll be back in the classroom, no more Zoom. So on Monday, I will see you in Paulson. Take care. Bye-bye.
Professor.
Thanks.
Thank you.
Thank you.
Thank you, Professor.
Bye-bye.
Thank you, Professor. Have a nice day.
Care.
Thank you.
Take care.